Silver is holding near $79 while the dollar just slipped below 97. And that combination tells you more about the next move in silver than any chart pattern ever could. Welcome back. I'm James. Today is February 13th, 2026. If you're new here, this is where we talk about silver and gold using structure. Not price predictions, not hype. Structure, positioning, and the mechanical forces that actually determine where price goes next. Subscribe if you haven't. It takes 1 second, and it helps this channel reach people who actually want to learn how markets work. And drop a comment right now. Tell me one thing. Are you currently holding any silver position, physical or paper? Yes or no? That's it. Because your answer helps me understand who I'm talking to and what level of detail to bring in future videos. Now let's talk about what just happened, and more importantly, what it means. There are moments in markets that look quiet on the surface but carry enormous information underneath. This is one of those moments. Silver didn't spike 10% today, it didn't crash, it didn't do anything dramatic enough to make mainstream financial headlines. But what it did is arguably more significant than any single-day move. It held. Microsilver, the July 2026 contract, SILN6, closed recently near $78.85, up 1.29% on the session. That's a modest green day by silver standards. Silver moves 1 or 2% regularly. Nothing unusual about the size of the move. Everything unusual about the context. Because this move happened after the CME Group raised margin requirements on COMEX silver futures. And margin hikes are not neutral events. They're designed to do something very specific to a market. Let me explain exactly what, because this is the plumbing that most commentary skips over entirely. Margin in futures trading is not a down payment. That's how most people think of it, and it's wrong. Margin is a performance bond. It's collateral. It's the money you post with the exchange to guarantee that you can cover your side of the trade if it moves against you. Think of it like this. You and I make a bet. We shake hands. But before we walk away, a third party, the exchange, steps in and says, hold on. Both of you need to put cash in this escrow account. If either of you loses, the money comes from there. That escrow is margin. Now the exchange doesn't set the margin amount randomly. They calculate it based on how much the contract's value could realistically move in a single day. Higher expected volatility means higher margin. Because if silver can move $3,000 per contract in a day, the exchange needs to make sure you've posted at least that much so the losing side can always pay. When the CME raises margin on silver, they're saying we believe the risk of large daily moves has increased. We need more collateral from everyone. And here's the mechanical effect that matters. Every single trader currently holding a silver futures position suddenly needs more money in their account. Not because they lost anything. Not because price moved against them. Just because the exchange changed the requirement. The bar got raised. For large institutions and well-funded traders, this is manageable. They wire in the extra cash and move on. But for leveraged retail traders and smaller funds, traders who entered near their capital limits, this is a direct threat. They were already close to their minimum. And now that minimum just got higher. Their cushion shrank overnight. Those traders face a choice. Post more cash, which they may not have. Reduce their position, which means selling. Or get liquidated by their broker, which means forced selling at market price. Margin hikes are the exchange's way of culling weak hands from the market. They filter out participants who can't afford the new cost of playing. And historically, when the CME raises margins during a silver rally, price tends to pause or pull back as that forced selling hits the market. Here's what makes this time different, and here's the first cliffhanger. Cliffhanger number 1. Silver didn't pull back. It went up. After the margin hike. On positive volume, holding near the highs. Why? What's different about the buying underneath this rally that made it immune to the exact tool the exchange uses to cool markets down? And what does that immunity tell us about what comes next? I'll answer that. But first I need to connect the second major development because these two events are not independent. They're reinforcing each other. The dollar index, DXY, has slipped below 97. It's trading near 96.85. And while that might seem like a small move on a big index, crossing below 97 carries weight that goes beyond the number itself. Round numbers in macro instruments act as psychological boundaries. When the DXY is above 97, the market narrative defaults to the dollar is stable. The dollar is holding. That narrative keeps capital allocated to dollar assets. It keeps portfolio managers comfortable with their existing positioning. It keeps the headwind on precious metals in place, because a stable dollar means there's no urgency to diversify. When the DXY drops below 97, the narrative shifts, not dramatically, subtly. But subtly is all it takes at the institutional level. The conversation changes from the dollar is stable to is the dollar weakening? And that question, once it's being asked in portfolio strategy meetings, leads to action. Gradual, measured institutional action. Diversification into real assets. Increased allocation to commodities. Hedging dollar exposure with metals. This isn't speculation about what institutions might do. This is how institutional portfolio management works. Narrative drives allocation, and the narrative just shifted. Now connect the two. Silver absorbs a margin hike, which should cause selling, and holds its gains. Simultaneously, the dollar breaks below a psychological threshold, which should attract new buying into metals. Resilience on one side, fresh tailwind on the other. Both happening at the same time. That convergence is what makes this moment significant, not the price level, the convergence. Now let me address what we don't know, because this analysis has gaps, real gaps. And I need to be transparent about them because building a thesis on incomplete data without acknowledging the incompleteness is how people get hurt in markets. The 10-year Treasury yield is not confirmed for today. I pull this from Fred's DGS 10 series, which is the most reliable public source. The latest observation is not available as of this recording. And yields matter enormously for silver because they represent the opportunity cost of holding a non-yielding asset. If yields are softening toward 4.10%, that strengthens the bullish case. If yields are rising back above 4.25, it weakens it. Without this data point, the macro picture is incomplete. The COT report, published February 3rd, shows the open interest structure, but the detailed breakdown between non-commercial speculative positioning and commercial hedging is limited in the futures-only format this cycle. We know participation is active. We can see the aggregate numbers. But the granular long-short split that lets us measure how crowded the speculative side is versus how heavily the commercials are hedging, that resolution is fuzzy right now. And PSLV Holdings data, which I use as a gauge of institutional physical demand, is not available for this period. Without it, I can't confirm whether the physical market is accumulating in line with the future's strength or diverging from it. 3 data gaps: yields, positioning detail, and physical demand. I name them explicitly because these aren't minor footnotes, they're material inputs. And their absence means my conviction level is moderate rather than high. I'm bullish on silver right now, but I'm bullish with awareness of what I don't know. And that distinction matters. Cliffhanger number 2. There's one framework that could explain why silver held after the margin hike, and simultaneously explain why the data gaps might matter less than you think. It involves the delivery window, and it changes how you evaluate who is actually driving this market. Let me explain. The delivery window is the period at the end of a futures contract's life, when holders can demand physical delivery of the underlying commodity. For silver, that means actual bars of silver, meeting specific weight and purity requirements, transferred from a COMEX-approved warehouse to the contract holder. Most futures contracts never reach delivery. The vast majority are closed or rolled to the next month before the delivery window opens. Speculators don't want 5,000 ounces of silver showing up at a warehouse. They want the profit from the price move. They close before delivery and take their cash. But some participants do want delivery. Refiners who need feedstock, industrial consumers who use silver in manufacturing, and increasingly funds and trusts that accumulate physical metal on behalf of investors. These delivery-oriented participants behave fundamentally differently from speculators. They don't respond to margin hikes the same way. A margin hike increases the cost of holding a position. For a speculator, that's a direct hit to their capital efficiency. For a delivery buyer, it's a carrying cost on metal they intend to own anyway. The margin hike doesn't change their end goal. They still want the silver. They'll pay the margin. They'll take delivery. And they're not going anywhere. Now here's the connection to today's resilience signal. If a meaningful portion of the current long interest in silver is delivery-oriented rather than speculative, then the margin hike filtered out the speculators, but left the physical buyers untouched. And those physical buyers are the ones holding price up. This would explain why silver didn't drop. The margin hike did its job. It removed weak hands. But the remaining hands were never at risk of margin calls because they're not trading for leverage. They're accumulating metal. And if this is true, it means the market's foundation has shifted from speculative momentum to physical conviction. That's a fundamentally different kind of rally. Speculative rallies are fast and fragile. Physical accumulation rallies are slow and durable. The data that would confirm this theory is exactly the data we don't have today. PSLV Holdings, COMEX registered inventory changes, detailed COT breakdown showing who is holding the long side. So the data gaps aren't just missing information, they're the missing confirmation of the most bullish possible interpretation of current price behavior. That's why I say they matter. And that's why I'm bullish with moderate rather than high conviction. Now let me bring in the cross-asset picture to frame the scenarios. The dollar at 96.85 below 97 is a confirmed tailwind. That's the green light on the macro dashboard. Yields are unknown. That's the yellow light. Could be green. Could be red. We need the data. The margin environment is tightening. That's a headwind for leveraged participants, but potentially a non-factor for physical buyers. Call it amber, context dependent. And the KOT structure shows active participation, but without the resolution to know exactly how active and exactly who is active. Another yellow, one green, three yellows. That's a cautiously bullish dashboard, leaning constructive, but incomplete. Let me map this into scenarios. Scenario A is bullish confirmation. Silver's resilience is validated and price advances toward 80 and beyond. This scenario becomes the base case if the following conditions develop. First, silver holds above 78 for 5 consecutive sessions or more after the margin hike. Time above a level after a shock is the simplest resilience metric. Each additional day above 78 strengthens the floor. It tells you that the margin-driven selling has been fully absorbed, and the remaining bid is structural. Second, the DXY continues to drift lower, moving toward 96 and potentially below. Sustained dollar weakness converts a one-time narrative shift into an ongoing institutional tailwind. Every session the dollar spends below 97 reinforces the diversification thesis. Third, when 10-year yield data confirms, it shows softening. Below 4.10% removes the opportunity cost headwind and completes the dual tailwind configuration, dollar down plus yields down. Historically, this combination has preceded the most powerful legs higher in precious metals. Fourth, the next readable COT report shows stable or rising open interest. Stable open interest after a margin hike means the surviving participants are well capitalized and committed. Rising open interest means new capital is entering despite higher margin costs. Both are constructive. Fifth, physical demand data when available shows continued accumulation. PSLV adding ounces. COMEX registered stocks declining. Any evidence that metal is being pulled from the system and held confirms the physical conviction thesis. In scenario A, silver grinds toward 80 on a stronger foundation than most momentum rallies achieve. The margin hike actually helped by cleaning out the weak hands. The dollar tailwind provides ongoing fuel, and the physical bid creates a floor that paper selling struggles to breach. Scenario B is the delayed rejection. The resilience fades, and the margin pressure wins over time. This scenario triggers if the following conditions develop. First, silver fails to hold 78 and breaks below the weekly close or yesterday's low with increasing volume. A decisive break lower would signal that the buying that absorbed the margin hike was temporary, not structural. The remaining longs weren't physical buyers. They were stubborn speculators who eventually ran out of capital. Second, the dollar reverses back above 97. If the DXY reclaims 97 and pushes toward 98, the narrative shifts back to dollar stability. The institutional diversification impulse pauses. The tailwind becomes a headwind again. Third, yield data shows elevated or rising rates above 4.25%. This would intensify the opportunity cost argument and add macro pressure on top of the margin pressure. Silver would face a dual headwind instead of a dual tailwind. Fourth, the CME raises margins again. A second consecutive hike would compound the capital drain on remaining longs. The first hike filtered the weakest hands. A second hike starts reaching moderately capitalized traders. Each successive hike shrinks the pool of participants who can afford to stay. Fifth, open interest declines sharply in the next COT report. Falling open interest with falling price is the definitive signature of liquidation. Not new shorting, existing longs exiting. That's the market telling you the rally's participants are leaving. In scenario B, the current resilience was a pause, not a foundation. And the eventual decline catches traders who mistook holding for strength when it was actually the calm before the pressure overwhelmed. Cliffhanger, number 3. Here's the question that decides between scenario A and scenario B, and it's deceptively simple. Who is on the long side of this market right now? Are they speculators who will eventually be forced out by margin pressure? Or are they physical accumulators who don't care about margin because they're taking delivery? The answer to that single question determines whether silver's behavior after the margin hike is the most bullish signal of this cycle, or a brief pause before a meaningful pullback. And the frustrating truth is that the data we need to answer it conclusively is exactly the data we don't have today. The detailed COT breakdown, the PSLV holdings, the COMEX registered inventory changes, which is why my checklist starts with finding those answers. 5 things I'm watching, starting right now. Number 1, 10-year Treasury yield from Fred DGS 10. This is the priority data gap. Below 4.10% completes the bullish macro picture. Above 4.25% challenges it. I will update as soon as this data confirms. Number 2, consecutive sessions silver holds above 78 after the margin hike. This is the resilience clock. Every day above 78 strengthens the floor. A break below resets the clock and shifts the outlook. I'm counting. You should be too. Number 3, DXY trajectory below 97. Continued drift toward 96 sustains the tailwind. Reversal above 97 pauses it. Watch the daily close on the dollar, not the intraday fluctuations. The close is what matters. Number 4, next COT report with readable positioning breakdown. I need to see non-commercial versus commercial positioning clearly. Stable or rising open interest after the margin hike is constructive. Declining open interest is a liquidation signal, and the ratio between speculative longs and commercial shorts tells me how crowded the trade is. Number 5, physical demand data whenever it becomes available. PSLV ounces held, COMEX registered inventory changes, any evidence of physical metal moving from the system into private hands. This is the confirmation that separates a speculative rally from a structural advance. 5 signals. Each one addresses a gap or a confirmation point. Track them with me. Let me close with this. Silver did something after the margin hike that most markets don't do. It absorbed the pressure and advanced. That's not normal. And in markets, when something abnormal happens, you should pay attention. Not because it guarantees anything, but because it might be telling you something the rest of the market hasn't recognized yet. The dollar is cooperating. Breaking below 97 is a meaningful narrative shift for institutional capital allocation. The data is incomplete. Yields, PSLV, COT detail, all missing or limited. And the margin environment is tighter. Leverage costs more. The rules favor the well-capitalized. I'm bullish, directionally, structurally, but with the discipline that comes from acknowledging what I don't know. Conviction should match the quality of information. Right now, the information is supportive but incomplete, so my conviction is moderate. And my risk management is tight. This is education only, not financial advice, not a trade recommendation. I'm sharing a framework. Build your own, trust your own process, and always manage your risk. Now, 2 questions for you in the comments. Question 1, binary choice. Do you believe silver's post-margin hike resilience is a genuine structural signal or a temporary pause? Just type genuine or temporary. Question 2, pick one of 3. Which missing data point would most change your outlook if it confirmed? A, the 10-year Treasury yield. B, PSLV physical holdings. C, detailed COT positioning breakdown. Pick one. Tell me why. I read every comment. Your engagement shapes these videos directly. I'm James. February 13th, 2026. Silver held the test. The dollar cracked. The data is incomplete. And that combination is exactly why I'll be back soon with updates. Stay sharp. Stay patient. Count the days above 78. I'll see you in the next one.